Hello and welcome to my next video in the general accounting series called Accounting Assumptions. The first assumption I'll go over is the going concern assumption. This states that all accounting information has to be reported like the business will continue to be operated instead of being closed or sold. What do I mean by this? It means that all assets have to be reported at what you paid for them, not what you think you can sell them for. For instance, one good example of this is land. Land over time accumulates value. So if you buy land and you let it gain value for over 20 years, so say you spend $1,000 on a piece of land and it slowly gains value over 20 years and now it's worth a whopping $2,000, and you report in your books that your land assets increased over that 20-year period, then it makes your company look like it's worth more than it actually is. And the reason we want to ensure that this principle is, in place, if your company looks more valuable than it actually is, then you're lying to investors. If it looks less valuable than it actually is, then you're lying to investors, and you don't want that. You're also frankly lying to yourself and lying to the government, which is not a good thing at all. So you want to state your assets as what you paid for them. Unless, of course, you are going out of business, then by all means state them as what you can sell them for, because by that point, what does an investor's opinion matter if you're going out of business? The next assumption is the monetary unit assumption. This means that all transactions need to be reported in monetary units. What do I mean by monetary units? The US dollar, the pound, the euro, if you live in Mexico, dinero, basically any form of currency that a government entity supports. Why is this important? Well, money is the common denominator in business. And it's an easy way to show how you're doing versus how your competitor's doing. It's an easy way to show how, if your company is doing versus a company that's not in the same field. So say if you own an engineering consulting firm and I own a warehouse firm, how would an investor know what to invest in? Well, how much profits do you bring in? What's your profit margin? How much money do you guys own? So there's no way to accurately track progress accurately without money. Many businesses keep reports in monetary units. Actually, that's a false statement. All businesses keep reports in monetary units. And you should too if you own a business. The next assumption is the time period assumption. So it's also very important. Life of companies have to be able to be divided into time periods. Why is this important? And what exactly is a time period? Well, a time period can be years, a quarter of a year, or 3 months, months, so a twelfth of the year. Basically, if it's a useful amount of time and a report can be generated, then that's good. That's a good report. So what do I mean by useful reports? Basically, if there's not enough information in that report, then that report's useless to investors. So you want to have a good amount of time, like a month at the very least, to ensure that the report has enough information to show that over this month we had this many transactions, we sold this amount of goods. If you only showed a day, then it's not an accurate description of your business. The final assumption is the business entity assumption. Basically, the business has to be accounted separately from other business entities, including the owner or owners of the business, depending on what kind of business you're running. Why is this important, and what do I mean by this? Well, basically, if you keep track of all your assets and all your cash that you personally, as the owner of the business, control, if you keep track of that along with and add it to the business, then the business looks like it has more cash on hand, or has more land or has more assets than you actually have. Or say you just took out a major loan for your house and you keep track of that loan in your business's books, your business looks like it has an extra liability that's just frankly can't be accounted for. A business entity can take 3 forms: sole proprietorship, partnerships, and corporations. Now, if some of you are probably thinking, well, I already know all about these. They're simple. Well, I'm going to break it down for you anyways, and it's going to be really painless, I promise. First one is the sole proprietorship. Now, some of you probably already know this or have encountered this. It's owned by one person. Now, there's a lot of disadvantages to a sole proprietorship. The main one, though, is that it has something called unlimited liability. So if your business does something wrong, like McDonald's a few years ago had this happen to them, their coffee was hot, and the coffee spilled on one of their customers. McDonald's was sued. Thankfully, though, McDonald's wasn't a sole proprietorship. McDonald's is a corporation. So McDonald's itself was liable, but McDonald's shareholders were not liable for what McDonald's did or accidentally did, or however you want to put it. But McDonald's shareholders and their owners, quote unquote, were not responsible for that spilled coffee. Now, if you owned a coffee shop and you had hot coffee and it spilled on one of your customers and you were sued, your company would not only be responsible to pay out that lawsuit, but you as the owner would be responsible to pay out part of that lawsuit if your company didn't have enough assets on hand to pay for it. And that's very dangerous to have happen. Its main advantage, though, that I want to go over is that it's taxed only once. And what I mean by that is, for the government's sake, the income of that business is the income of the person who owns the business. So if you make a certain amount of money as in a sole proprietorship, then that income is only taxed once by the government. It's not going to be taxed again when the money that the company owns is transferred over to you. So one quick point, though, that the government may look as you, as the company and the person, as one entity, but for accounting purposes, you have to keep your books separate. The next one that we're going to go over is partnerships. This is owned by 2 or more people. So if you enter into a partnership with somebody or with multiple somebodies, if you want to get really weird and have hundreds of somebodies as a partnership, it's still a partnership. It just depends on how many people are in it. In a partnership, you're jointly liable for tax and other obligations. So basically, if you went into a partnership in that same coffee shop in the previous example, and you were sued because hot coffee was spilled on somebody, both of you as the partners would be responsible for that spillage of coffee, depending on how much you own of the company. You would be responsible for that percentage of the lawsuit. So a good point in this is if it's not a 50-50 split between 2 people, like if it's a 60-40 or a 70-30, you would be responsible for more and more of the lawsuit depending on how much you owned of the company. Or say if you entered into an agreement with the person saying that I agree to pay all lawsuits and be completely liable for all lawsuits by the business if so-and-so promises to pay the mortgage or whatever, however it is. It's the same with taxes. If you own the larger percentage of the partnership, usually you're responsible for more of the taxes. And also, as like in a sole proprietorship, in partnerships, you are not separate. You're not legally separate from the business as the owner. The third and final one that I'll go over, a business entity that I'll go over today, is called a corporation. Corporations can be owned by one or more persons, and these owners are called shareholders. The main difference between a corporation and a sole proprietorship and partnerships is that a corporation is legally separate from the owners. This is why when McDonald's, the corporation, got sued, the shareholders were not able to be sued by this lady. That's actually the main advantage of being a corporation. It means your company is more protected. You're more protected as the owner than if you were in a sole proprietorship. The main disadvantage, though, is double taxation. And this may seem a little confusing, but I can break it down, I promise. All right, so say a company makes a certain profit. And as we learned in previous videos, a company is allowed to pass out dividends to their shareholders. Now, the profit is taxed. How much the company makes is taxed by the IRS. That dividend, when it's passed out, is also taxed. Do you see what I'm trying to get at here? It's the income of the company is taxed, and then the dividend is also taxed. This is big because Uncle Sam can make twice as much off the same money, and sadly, if you were the single shareholder of a corporation, you'd make slightly less, but you'd be protected legally. So there's disadvantages and advantages to each of these different types of business entities. All right, thank you all very much for your time. This was my accounting assumptions videos. Stay tuned for the next video. Thank you.